Thank you so much. So any questions, if you're still with me? Any comments?
You know what I mean?
Yes, Jean-Claude, I'm glad you're still here.
Yeah, I'm still awake, still here. Um, Lucas and I had a discussion last week. We were talking about vertical spreads, and
Yes.
I was doing them a lot. And so initially, I was doing like weekly
Mm,
options. So I thought you have the time decay, exponentially, happening like, the time decay was a lot during the last 5, 6 days of the option. So you had that working for you as well. But then I noticed the gamma risk, or when the move in the stock affected the price of the option a lot.
yeah.
And then I was reading that some traders were recommending doing um 50 days out, 40 days out, up to 20 days, and then closing the position at 20 days, so you don't have that gamma risk at the end. What are your thoughts on that?
Very good question, Jean-Claude. I would, so the most ideal, if you think about vertical spreads, and I think if you look at my, I've done a video on that. The most ideal thing for the trade, for the investors is 45 to 60 days. That's the optimum, which allows you to close between 3 or 4 weeks before. So that's as far as the optimum or maximizing your profits. I would say I would be a swing trade. I would do a 45 to 60 days. Now you could do weekly, and I would prefer, like for weekly, I like the calendars, for instance, or the horizontal rather than vertical when it's like really short term. But for the verticals, that would be optimum, unless you're playing like again, like some specific behavior. SPX now has like every day has expiration every day. So
Mm.
that's you can look at it as more of a day trading kind of a thing with the verticals on that, knowing that you have everything is on a daily, for instance, the, uh, the, the volatility is very close for those spreads. So you don't have the risk of, let's say, 7 days. But yeah, to answer the short answer would be, if you're going to do this continuously, especially if you're going to do with ETFs or very liquid, you've got to do very liquid ones, stocks, I would say 45 days would be optimum. I would do
Mm.
45 to 60 days and close it 3 or 4 weeks. I mean, that would be the,
Before,
yeah,
yeah,
so yeah.
cool. And the other question, or I mean, I had was, I've been working on, for my kids, looking at you know, a selection of uh, an allocation of mutual funds that they can put, money towards on a monthly basis over the next 30, 40 years,
Mhm.
And so these are very low cost funds, and it's automatic, so they don't have to worry about it. It's deducted
Right.
and automatically. And I was looking, I wanted some allocation towards international. And I was looking at the international ex-US, but also not emerging markets. And I
Correct.
noticed that since 2008, it hasn't gone anywhere really, the international market. It's been like practically flat. I was wondering, um, what are your thoughts? Why is that? Why hasn't it gone anywhere? Is it because all the money's been going towards the S&P during that time? And
Yeah, so we get these cycles, Jean-Claude. If you go back, for instance, 1980s, and then we look at the 2000 to 2008 or 9, for instance, these cycles repeat. And of course, after 2009, if you look at the US growth, especially like NASDAQ, it became the magnet for all the investments. You look at some of the charts, you go look at the UK, look at Germany, look at a lot of Europeans. you see for like 10, 11 years, they're flat. They haven't done anything. Even
Mm.
China, when you look at a few years, India was an exception. They've done well for the past 20 years. So the money flows from one, again, cycle of markets, whether it's dollar based to the outside. And I think my assumption past 2 years, I think you've spoken, I believe the decade of 20s, things are gonna start moving away from United States in a manner that based on valuation alone, and just because of the again, putting this past year aside, we will see from the valuation point of view, you will have more attractiveness. Now, the problem is right now in the short term, obviously you have this energy crisis, you have inflation, and now you might have recession in Europe. The question is, would that create a buying opportunity, for instance, in Western European or in UK, or even in some of the emerging European, would that be a positive place to do? You have to be really patient. If you're doing dollar cost averaging, then you will be okay. My thing is for the next 20 years, next 15 years, just from demographic point of view, right? So from aging population in the United States to more of a developing, as far as a middle class consumers in developing countries, even internationally, you look at is a lot of economies, they have very aging population, especially if they have to be supported. So that puts a lot more pressure, and that includes China, in my opinion. So that's the reason I've been like advocate of, let's say, countries like Vietnam, just because of that. And I see that what is happening with China, just with their COVID policy, as I said, I think President Xi is becoming more and more rigid because of this, the advisor, the committee that he chose, you see, is more of a yes people rather than as far as exchange of ideas. Then you see a lot of these, even semiconductor, for instance, we talk about Foxconn, right, from Apple, they closed down, there's problems with that. So Apple has started doing in India, getting more presence in India, but also they looked at Vietnam, for instance, and you see this semiconductor there in Thailand, Indonesia, Malaysia, but Vietnam is attracting a lot of business that would have gone to China, for instance. So the question is, we are looking at things at this moment, but I'm looking at, with it, especially with advancement of technology, with the internet or the net of net things. And, it's like, there's just so much advancements are happening that whether you become, there's been a concern about we're getting away from globalizations, we're becoming more of a nationalism, and it's happening like the elections around the world. Regardless of that, I think technology has made us borderless. And basically, if you look back and tomorrow, so these are the things I look at. I close my eyes, and when I sleep, I say, all right, how the markets are going to react. Let's say if China said, okay, no COVID, we are good, everything, we're opening the economy. Or Russia says, listen, we just give up. How would the world react? Now, immediate things will be obviously euphoria, I mean, especially in Europe, because it's relaxation. But the energy crisis is still there. In my opinion, there's been some mismanagement. We talk about alternative energy, we talk about, let's say, wind, and I think nuclear is more advanced than anything else, but we look at solar and other things. But I think we have to look at it's really long term. And I think Europe, when they started, and I know Germany, I used to be there like in the 1990s, and I would see the wind turbines and all that. They were looking at alternative investments. But times like this, when you have to operate big factories and the grids and other things are still the main thing will be fossil fuel for now, or even like natural gas has not been utilized as much. So I'm just thinking, okay, well, even the Ukraine didn't happen, or it happened, you still have some fundamental problems. But where are the opportunities? Those are the times that we look at and say, in the long run, which country can afford to have the human capital and the human consumption, as well as the technological capital, and as well as, again, we look at the fiscal side of things, we look at the mind that they're willing to accept the freedom to allow people to make decisions, that becomes attractive. I mean, when you think about, let's say, Iran demographically is a fantastic country. It has a very young population, very educated population. It has all kinds of resources, natural resources, food resources. It strategically is there. It has the shipping, you look at access to the water, both sides, and yet, just because of mismanagement and other things, would I invest there? Not, absolutely not. And I've looked at it for so many years, just because you don't know, you put that money in, if you're going to ever get it out, or if you're going to have anything. So those are the things we have to, that's what the geopolitics play a role. So you could have a wonderful country, but then you're not sure you will have access, or even who will control that money. So again, that was a long answer, but I'm saying that's why you have cycles. That's why we had the Japan's power in 1980s, for instance. We had the Chinese in 2000 plus, in 2000, they became superpower in the sense of the market opening. So right now, I think United States is going through growing pains. I think you just look at the Meta and some other company, you even look at Amazon, which has been unbelievable. You look at that and you say, well, all these giants are not gonna last, and as long as you think so. That's what diversification is. But yes, so to 2009, all the money started moving to United States, and basically the growth. And you look at the chart of NASDAQ, for instance, you look at the growth side of things, and that's why we have discussed this value versus growth a lot. So, and you also look at the small caps, and I think we've discussed that. Small caps really did nothing compared to mega caps and large caps in that 10 plus years, 11 years to the COVID hit. So you see, that's why you have to really, either you have to just close your eyes and if you recall, you do the 1N allocation and just put 1/10 in this asset, just close your eyes and just do that, and basically hope that in the long run they will do well, except when there's a big crisis or bubble, majority of asset classes they get hit. Or be a little proactive and look at the cycles. I mean, we talked about commodity cycles, for instance, 2 or 3 years ago. And, if you had your money in commodities for past 3 years, you would have done pretty well, regardless of, I mean, look at energy, for instance. Energy was beaten up. It was tiny portion of S&P 500. And now look, I mean, they have big influence. It just, it's the peak and troughs, right? So everything goes back to its mean. So I don't know. It was that a lot of talking, but did it help, Jean-Claude? Did that?
Yeah, absolutely. Absolutely. And I was just wondering, how you have equity, like average equity returns over the last 50 years, and that over the long term, you're going to get your 9-10% return per annum, on average in equities, right? So I was just wondering, I was trying to think whether international it was different, but I'm assuming it's equities everywhere, they command a higher return over long term, right?
Yeah,
Whether it's
yeah,
international or not.
correct. But as I mentioned, we do have these cycles that
Cycles,
money
yeah,
moves.
absolutely.
So I think um, this is my thoughts from 2020 to 2029, for instance. I think US markets will do maybe 5 or 6%. So, or the bond markets will do 1 or 2%. And I used to talk to a friend from Research Affiliates, right? So it was in 2017, we were discussing it, and he was thinking that 2020 and on, bonds will be nothing. It will be 1 or 2%. That was his projection then, and bonds have had a nice bull market. So again, that's what either asset allocation, or you just find these cycles and go with it. The last thing I would say, I don't want to take too much of your time, but like in 1980s, and because I was very active investing in gold and silver, my God, for 15 years, you got nothing. And then 2001, 2002, when we had the recession, you just go look at the chart of gold, all of a sudden in 4 or 5 years, we were up. But I think I had gold at 300, and of course we did go hit almost 2000. So that was like 7 times, or the silver. But for 15 years, it was the most painful thing. So we could have either said, well, 1980, I started investing in 1987, 86, 87 till 2002. Okay, you suffer, but then if you would have held on another 5 years or 6 years, actually 2011 really peaked. I mean, silver went to 49.70, something like that. And, I was buying silver at 7, but it stayed at 7 and 8 for the longest time. And then it just blew up. So it's either you have to stay with it, like you just said, long run, or just know your cycles, knowing that if the money interest rates are not attractive, the money is going to technology. We had the boom of 1990s. Nobody really cared about gold or silver. There wasn't a lot of inflation either. So it was basically a useless asset. But then we had a bubble like that, and people get scared. Then we have recession, then we have attack, and then all of a sudden, gold and silver became the darlings, and everything, just the money moved in there. And then, of course, the real estate started booming, and the use of the material. But then, anyway, so that's what I would say. Watch the cycle.
Thanks, Ramin. Appreciate it.
Of course. Fantastic. Hey, Lucas, are you at work, or could you hear us?
Oh yeah, I got home at like 5:10, so that's when I hopped on the call.
Oh, beautiful. Okay, good. All
Yeah.
right.
So I had 2 questions. The first one is regarding vertical spreads. Sometimes I do my I do like my debit vertical spreads out of the money. And the reason I do that is because I bring the risk reward ratio to like I'm talking about the worst case risk and the best case reward. I bring the risk to like 1 to 2 reward, 1 risk. Do you think that's a good idea?
So again, everything is about probability, right, Lucas? So when you do set it up, we've talked about, you start with your scenario. You look at the probability of what is, when we look at the expected moves, what are the chances of this happening? So basically, when you do like debit, obviously you have a directional guidance in your mind, and you think that there is a good chance we will hit, and then you just protect yourself. The way, if it's like way out of money, then obviously you're lowering your probability, right? So your risk reward, that looks good, 2-1, 3-1. So, but you also definitely want to make sure the probability is on your side. So it's almost like, do you want to hit a triple and a home run, or you want to have singles? So the idea of the verticals, we like the singles and doubles if we can, most of the time. So, but one good thing is, what you do say is, when you do use a lot of money, obviously you have less margin requirements, and you have a lot more flexibility to play maybe different issues that, using the same capital. So it's about capital management.
Right. And I do that when I'm like very like when I want to be aggressive, but I don't want to play like directionals.
Exactly. Yeah, absolutely. For instance, if there's a news coming and that there's when you look at your expected moves, for instance, and you see there's a good chance, then yeah, by all means, again, it is but it's all about probabilities. So,
Right.
but obviously the more out of money, then your risk reward gets much better. The problem is, what is the chances of that being in the money or making you money? So
Correct.
yeah, there's never like a shortcut. I'm sorry to say that, like it's just like, we always are trading up something. So
Right. Yeah. Okay. And then my second question was more subjective.
for
I
sure.
wanted to ask, so Friday morning I was looking at the markets and I was trying to paper trade it, and
Okay.
I was looking at potentially shorting the market around after 10 a.m. when the Michigan consumer sentiment came out very negative. And I saw how overextended we were. We were outside the LRC on, I believe it was the 4 hour, and I did a vertical spread shorting the market. And I was wondering, on a day like that where inflation comes in so low and everybody's all of a sudden more optimistic, do you think there should be like a reversal, like how you say turnaround Tuesday, like the next day should have a reverse reaction? What are your thoughts about that? Would you have taken a short like that based on what I just said?
So generally, what I look at, I mean, we've looked at this on FOMC day, right? So I don't put a lot of value on FOMC day. I always look at the following day. And generally, and I think I did it last week on lesson of the week, you could see, not all the time, but generally you have a reversal of whatever happened on Wednesday when the FOMC came. And the main reason is there's emotional reactions to what the Fed has to say. It is only 1 hour, right? 1 hour, 1 hour, 15 minutes to digest that. But then after hours, the we look at while our markets are closing, we have the overseas markets that are just opening and they start digesting the news. They look at the things happening. So by next day, you have much better understanding of what's going on. So that's why usually you have the reversals. Now, the exception, this thing was, there was a lot of fear. So there was some, we looked at American Association of Individual Investors. There was a lot of anxiety right after, again, after election. There was a lot of positivism first, and then we got that negativism. Then we got worried what happens on inflation. So there was this coiling, as I mentioned. So when that happens, Lucas, when the short covering happens, it continues. So the next day, we still unraveling, we still opening. And you're absolutely right. When that consumer sentiment came, although it was much worse than expected, we still in positive, by the way. You had 54. So still there's a positiveness. It wasn't like it went to 49, for instance. But with that in mind, what I would suggest is, because of that technical bounce and short squeeze and what was going on, and that's why I use these pivot points or so, you have to be a little cautious. And it's Friday on top of that. So I'm not a huge fan of, toward the end of the day, especially to trade on Fridays, because who knows what will happen over the weekend, for instance. So, but your observation is correct. In the majority of when there's big news coming up, you need time to digest, and generally people see things are not as good as they were promised or as bad as they thought. So so I don't know, what was the result? Did it work for you? Because the markets really became flat in a sense.
I know
Flat.
it didn't work. I lost on the trade.
Yeah. So you see that at the end of the day, they just don't want to basically, again, we kept our, we were in that zone, and they just thought, from the sentimental point of view, also, again, it's November, and seasonality. So there is midterm elections almost over. Another fear that there was, Lucas, there was the whether there will be orderly midterm election. Would they be fighting on the streets? There was that fear. So when that went away, also it put some clarity to the market. So but that's why I think Monday and Tuesday, I think it's important. We want to see whether we will hold our zones, and then, as I mentioned, we will easily can go up, or this was just let's just cover the shorts, just clean it up, and then start a new leg, maybe down a little bit, and then decide what's going to happen with the GDP numbers, for instance, what's going to happen with the employment. The earnings season is coming down, so it's not a lot except the retail numbers we want to watch to see. Black Friday is going to be important in some ways, just the attitude, and then the market is going to wait. Right now, the market has just discounted that, think that a 50 basis point will be sufficient. That's what they're priced in. So,
Right.
So yeah. So I mean, it is from part to part, but generally that will happen. But this one, this is the level that it happened. There was a lot of relief. There was a lot of people got relieved, whether it was, as I said, the violence or the numbers. They went and picked anything good about the CPI number to satisfy their own desires that, Fed is going to see this and they're going to think, oh, we are done. So,
Right.
which we are not, by the way. I can tell you right now. It's all, I don't think they're going to just look at one data. The only thing is they think the trend is going to be done. Looking at, again, maybe we had peaked, that's all. So,
Okay. Well, thank you.
of course. All right. Good. All right. Sorry again. Oh man, I'm thinking of you, Luke, and Jean-Claude. So thank you again for staying with us. And wow. So if not any questions, I'm gonna go ahead and record this and we'll send it out. And Jean-Claude, have a safe travels home.
Thank you.
We'll see you in a few days. And
Yeah.
then Russ, I hope I'll see you tomorrow. I hope there's not a lot of rain. I heard there's lots of rain is supposed to come Miami way. So I hope you stay dry.
Okay.
And
Yeah, I'll see you tomorrow at 8 a.m. PST.
you got it. Yes,
Okay.
let's do
Perfect.
that.
Sounds
All
good.
right. Have a wonderful weekend, everyone. Be
Thank you.
safe.
Thank you so much, Ramin.
Of course.
Bye-bye.
Bye-bye.